Greetings, traders. My name is Anya Somadabuchi, and I will be your coach in this session. Today, we're going to be talking about trend line. Remember, do not compare yourself with anyone else's progress. Always keep a winning mind frame, and you will do very well in this business. Upon finishing this lesson, you should know the answer to the following question: what is trend line? By definition, a trend line is a line connecting two or more lows or two or more highs, with the lines projected out into the future. What does a trend line tell you? A trend line is a line drawn over pivot highs or under pivot lows to show the prevailing direction of price. Trend lines are very visual representation, or trend lines are a visual representation of support and resistance in any time frame. They show direction and speed of price and also describe patterns during periods of price contractions or consolidation. Trend lines are probably the most common form of technical analysis. They are probably one of the most underutilized ones as well. If drawn correctly, they can be as accurate as any other method. Unfortunately, most traders don't draw them correctly or try to make the line fit the market instead of the other way around. In their most basic form, an uptrend line is drawn along the bottom of easily identifiable support areas. In a downtrend, the trend line is drawn along the top of easily identifiable resistance areas. How do you draw trend lines? To draw trend lines properly, all you have to do is locate two major tops or bottoms and connect them. To draw a quality trend line, you will need to find at least two minimum swing points and simply connect them with each other. The levels must be clear. Don't try to force a trend line. Don't use smaller time frame to draw trend lines. Use always the higher time frames depending on your trading strategy. From the picture you're seeing, you can see the lines as they are drawn on the chart, and you can see that price carefully respects the trend line. The trend line before now was used as a tool to identify the trend of the market. So the moment you draw a trend line and it points up or down, it simply means that moment of trading activity, that the price is in an uptrend. And if the trend line is pointing downwards or in a downward direction, it means that price is in a downtrend. This was the traditional ways of knowing the trend of the market. But over time, a lot of things has changed in the market, and new inventions and new strategies has also evolved, that people can easily spot the beginning of a trend without actually using the trend line. But the trend line is very important when it comes to trading because it helps you to know identifiable areas of resistance and support, either in an uptrend or a downtrend market structure. And secondly, it is also used as a tool to understand price liquidity, knowing your areas of dynamic support and dynamic resistance level, which are tools that fuels market liquidity. As you can see, the market respects the trend line, and when price approach it, the market reverse and continue in the same direction. So when the market moves this way, trend lines helps also anticipate the next impulsive move with the direction of the market. As you can see, the market respects the trend line, and by drawing it the right way, we can easily predict the next movement upward or downward. This is all what we can say about trendline markets. I think it's clear and simple. Now what I want you to do is to open your chart and try to find trending markets and see how you can connect your own trend line. This video is going to have a part 2 where I will dissect the ways trend lines ought to be used to determine the direction of a price and to also to determine entry points and liquidity areas. Is that clear? So you could see that from this picture, you can see how price is bouncing on the trend lines. All right, and this is known as an ascending channel. Before now, it was used as one of those traditional ways of trading the market to know when the market is ready for a downtrend and when the market is still in an uptrend. So right now, with this trend line approach, you can see that the market is what is uptrending. This is an uptrend market structure. So most traders before now, what they usually do is when price bounces on the trend line and does not close below or above the trend line, they execute a trade based on the zones price is testing the trend line. For instance, this is the time price tested the trend line. And by the way, this is what we know as a dynamic support. The support that bounces on trend lines are known as dynamic support areas. And a dynamic support are all liquidity zones. Same thing with what dynamic resistance areas. They are all known as liquidity zones. Price will definitely come to take them out, and which I'm going to show you in this video. All right. Now, this is how it works. So when price bounces off the trend line, please, this is not a strategy. All right. This is a huge disclaimer out there. This is not a strategy, so that I'm just trying to explain to you how price reacts within the trend line zones. All right. So when price bounces off the trend line and closes, for instance, this is a bounce on this trend line and price did not close below this trend line. You see that price closed above this ascending trend line. Most traders will initiate a buy trade and take profit when price hits what the resistance of what the ascending trend line. All right, and then you notice what happened here again. Price came and bounced off this trend line and did not close below this trend line, but it closed above the trend line. Yes, some persons use this as their way of trading the market. They will launch a buy trade and take a buy trade on this trade, and then take a TP when it hits the resistance, and initiate a sell trade whenever price did not close above the resistance. If price closes below the resistance of the trend line, they take a sell trade. All right, so these are people that are called zone traders. They trade from zone to zone within the space of what the ascending trend line. So when price breaks the ascending trend line and creates what a new high, all right, they will understand that the market has shifted trend to the downside. Is that clear? So like I said before, these areas, these dynamic supports are all liquidity zone, and liquidity simply means places where retail stop losses are being placed. So the market will definitely ensure that all this liquidity, all these dynamic support areas are taken out in the market. All right, when the market is in a downtrend. So I want you to understand that trend lines are very important. We also have a descending channel where price is doing what? Price is trading in between what? The channels. And anytime price breaks the channel, all right, and does what? A retracement, okay? This can also signify what? The beginning of what? An uptrend down to this area of liquidity. You see that? So this is how most persons use the trend line to identify which direction price is going. So if the trend line is pointing upward like this, it means that price is doing what? Price is creating series of dynamic support on the trend line, and you can say that this is what? An uptrending market. And if the trend line is pointing downwards, it means that what? Price has been what? Finding resistance on the trend line, which is making price to come down, and you can say that market is in a downtrend until the trend line gets broken. We will now know that what? That is what? A reversal point for the beginning of an uptrend. Do you understand what I'm saying? So in the part 2 of this video, I'm going to break to pieces everything you need to know about trend line and how you can use trend line, all right, for the purpose of effective trading. So you can see in a downtrend, the moment you notice that price approaches your trend line and did not close above your trend line, it signifies what? Weakness of buyers. So you can launch a sell trade. You can see that how price approach the trend lines and they keep declining whenever they approach the trend line. So anytime price breaks above this trend line, that could signal what? A reversal point for the beginning of what? An uptrending market. All right. So let us know the important things to remember about trend lines. Number one, it takes at least 2 tops or bottoms to draw a valid trend line, but it takes 3 to confirm a trend line. Please don't forget this. Number 2, the steeper the trend line you draw, the less reliable it is going to be and the more likely it will break. Number 3, like horizontal support and resistance levels, trend lines become stronger the more times they are tested. All right. And finally, do not ever draw trend lines by forcing them to fit the market. If they do not fit right, then that trend line isn't valid or is not a valid one. All right. So you can see from the pictures you're seeing here, you see that the trend lines were what? Placed correctly on price. When I say price, I'm talking about the candlesticks. All right. You see that they are placed correctly on price. So that way you're not forcing it. It must what? It must be an identifiable resistance, and then you connect them to make a trend line. Or identifiable support, for instance, look at this zone. You connect them to make what? A trend line. Is that clear? So this is the end of this video. All right. If you have any question, please do not hesitate to ask me on the comment section, as I am ready to reply you immediately. So wait for the part 2 of this video. Bye for now.